Hello and welcome to today's Office Hours presentation. This is Paul Hoyt, your host. Our Office Hours is a relaxed, informal mentoring program that we do every Monday at noon Pacific time. All these recordings, slides, and exercises are archived in our members area of our website, and all the recordings are currently available on my YouTube channel at youtube.com/user/Paul Hoyt. The reasons we do these Office Hours presentations is that we know that being a successful business owner can be a great experience, but we also know that it's tough. You really need education, training, tools, and team members to be successful, and we want you to get to know us because when you do, you'll know that first and most importantly, we really do care about you. We want you to be successful in every area of your life, not just your business, but every area of your life, whatever that means to you. We want you to find the greatness, the happiness, the divinity within yourself, and then remember it, embrace it, and live it every single day as we do. Our passion is to accelerate or to increase the survival rate, accelerate the growth rate, and reduce the struggle rate of businesses in America. And our vision is to help millions of CEOs and entrepreneurs accelerate their business growth while enjoying greater harmony and balance in their lives. If you find these Office Hours presentations beneficial to you, please pass the word. It's always free for somebody to come and attend one of these sessions live. In some number of weeks, access to the back office will be limited to members in our website. But for now, all of them are available, and we want to share as much as we can and help other people as much as we can. In these Office Hours presentations, we give an in-depth discussion of a business success principle, then offer some closing remarks, special offers, and an invitation for future sessions, and then we go into open Q&A and coaching. So as we're going through the Office Hours presentation today, write down your questions, and you can ask them at the end of our broadcast, and you can also type them into the chat log. Joining me today in Office Hours is Stephanie May, my right-hand gal, who will be corresponding with you and interacting with you via the chat log while I focus on the presentation. We also invite you to join us in the Awakened CEO communities on both LinkedIn and Facebook, where we publish the business success principle of the day about 4 times a week on both Facebook and LinkedIn. And every morning, I do the energy of the day posting on Facebook, where we offer a little insight and an inspiration first thing in the morning. Today was day number 914 in a row. So I'm looking forward to day number 1,000, which is not that far away, because I think that'll be a really significant milestone. Today we're going to talk about money. We're going to talk about the process of financial modeling. We always try to relate the subject matter of the day to one or more of the key performance areas of success that I introduced in my book in 2004 called The Foundation Factor. And this is all about financial management. It's also about leadership, because it's up to you as the leadership of your company to develop a viable business model. And one of the ways you determine whether or not you've developed a viable business model is by doing a financial model. We also try to talk about the Awakened CEO system, which is our balanced and comprehensive approach to business growth on multiple levels. And the 3 levels we like to focus on and encourage you to focus on are mindset, which is your beliefs and perspective, your methods, which is your plans, processes, and your procedures, and your momentum, which is about taking action, repeated action over time, accelerating your velocity and thereby accelerating your momentum. And today it's really about methods. We're going to talk about the process by which we create financial models, which is one of the key aspects of planning that every business owner needs to do. And in our agenda today, we're going to talk a little bit about the overview about financial modeling. We'll talk about this, we'll give a step-by-step example of financial modeling and walk through my 9-step process for developing financial models, and we'll offer some tips and we'll sum it all up to the bottom line. First of all, a little bit of an overview. If you know me at all, you're going to find out one thing really quickly, and that is I love accounting. I really love accounting. I love the double entry bookkeeping system. I love being a CFO for about 4 or 5 clients right now, and I love the process of financialing. I really actually love financial modeling, so much so that I've completed 150 or so in the 15 years that I've been a business consultant. My focus is to create investor-grade financial models that have 6 different projections to them, or 6 different spreadsheets that are typically attached to the back of one of my investor grade business plans. And that is the income statement, the cash flow statement, and the balance sheet year by year and then month by month for the first year. Every once in a while I ask somebody, or somebody asks me to create those month by month projections for all 3 years, which I'm happy to do. And every once in a while somebody asks me to create 5-year projections. The normal is 3-year projections. But you know, if you have a franchise, if you have an opportunity that is very slow in development, where you really can't being cash flow positive in the first 18 months or so, then we go ahead and do 5-year projections. And every once in a while I get somebody that says they want to do 7-year projections. I think I've only done 7-year projections twice, and in both cases it was because the first 3 or 4 years were spent in development, and it was going to take that long to get a product to market. So they weren't actually going to get into revenue until, you know, the middle of the 3rd year or the 4th year, and they really needed to do 7-year projections to demonstrate to their investors when they might actually get into revenue and when they might actually reach some sort of cash flow positive scenario. Not everybody, by the way, needs to do complete financial models. Very, very early stage companies where they really don't know what their products or services are and they have no idea what their revenue is, and internet companies, which here in Silicon Valley we see a lot of those. With both of those types of scenarios, revenues are almost impossible to predict. And by the way, I'm going to define an internet company, and that's a company that wants to go out and attract a whole bunch of attention to their website and develop a way of interacting with their clientele, but they really don't know how they're going to make their money yet. Curiously, Google, LinkedIn, Twitter, and many other very large sites, Facebook, for example, were able to develop a tremendous following from millions of people before they ever figured out how they were going to make money on the website. That's an extremely rare example to where that works, which is build the traffic first and then figure out how to monetize. For most of us, we need to figure out how to monetize our business from the very first day, and that's especially true if you're having a physical product. If you're delivering an online service, not so much. If you're delivering a professional service, like whether it's a labor-intensive engagement, you really need to figure out what your products and services are and how you're going to sell them, etc., to start off with. But especially if you're having a physical product business, you really, really need to have a complete model. But in these two cases, if you're a very early stage company and you haven't figured out how you're going to make your money yet, or if you're an internet company, in both those cases, you really do need to understand what your expense profile is, and you really need to understand what fixed assets you need to purchase for at least the next phase of growth, if not the next couple of phases of growth, so they can go into a use of proceeds so that you can explain to your investors why you need their money today, but you don't even know how you're going to make money with your business yet. They at least want to know how you intend to spend the money that you are raising. So let's talk about why do these projections in addition to really understanding how you're going to spend the money you're raising. Some companies do financial modeling because they're seeking loans or loan renewals. It's been my pleasure to work with many different clients who had the opportunity to, say, buy a new business location, buy a building, or they had an opportunity to get a loan from a private family trust or some other person that they knew who said, just show me how you're going to use the money. In the case of banks, they really want to know how you're going to spend the money, and they want you to demonstrate to them how you're going to be able to repay that debt through your financial projections, and especially if they have a line of credit with you. So if you have a line of credit with a bank, one of their aspects of due diligence is they want you to develop financial models and financial projections literally every year so they can determine whether or not it's in their best interest to continue with that line of credit with you. And unfortunately, sometimes a bank will say, you no longer fit one of our profiles, that we no longer have the confidence that you'll be able to repay the loan from the financial results that you have delivered and the financial projections that you have shared with us, and you have to switch and find another bank to give you a line of credit. I've helped a few clients through that process as well. So seeking loans or seeking renewals of lines of credits is one of the reasons why we do the financial projections. The biggest reason, however, is if you're raising capital, because most sophisticated investors will want to know that you have a plan to make money. They'll want to know when you plan to break even, how much money that you think that you need in order to start and grow this business, and really understand how big of a company it is that you intend to grow, so they can determine whether or not their $10,000, $20,000, $100,000 is going to yield them a significant return, and at what point in time they might expect beginning to enjoy a distribution of profits. And they also, by the way, want to know what your intentions are with regards to acquisitions and mergers, so that they can get all of their money back out of the business. They really want to know what their exit strategy is, and your financial model is a huge part of communicating to them what your exit strategy is. One of the biggest reasons that most people don't talk about, but I really love when it comes to doing financial models, is what I call business model diligence. Whenever you do a financial model, and especially whenever you do a business plan, it really facilitates the entire process of thinking this thing through. And I'll talk about that for a little bit. In business model diligence, when you do the financial model, you're really checking to see whether or not you have a viable business model at all. I have worked with many clients who, when we got to the end of the financial modeling process, we determined that this really wasn't a viable business model, that they were not going to be able to make a significant profit with the products and services that they had planned, in selling them in the manner that they had planned to sell them, at the price points that they had planned to sell them. And it really facilitated the thinking of it through and the adjustments to the overall business model. Because when we go through and do the financial modeling, you do get an opportunity to discover your profitable product lines and distribution channels. We also focus on the reasonableness of the expenses that you had planned to make, and determine the cash that is really required to grow the business. All of that goes into determining whether or not you have a viable business model in the first place, and what adjustments you need to make to your business model to make it more profitable. For example, a lot of times we'll discover that you had planned to bring out product A, and then product B, and then product C, but you find out that product B is far more profitable and will generate cash much more rapidly than product line A, so you switch them around and you decide to come out with product B before you bring out product A, because it will lessen the cash flow requirement of the business. Or you may have thought that you were going to bring on 10 or 15 people from the very outset of the business, but decided that that's going to take far too much cash, and you try to create a business plan, a business growth strategy that allows you to grow the business with, say, only 4 or 5 employees until you get into revenues, which, by the way, I hope to say this other places in the presentation today, but once you are in revenue, and especially once you've achieved some level of financial stability, you'll find it a lot easier to raise the capital that you need to expand the money, or expand the business rather. So startup capital is much more expensive and much harder to raise than expansion capital is. So I always coach my clients to get into revenue as quickly as possible, and then have a relentless pursuit of financial stability, because growth capital is so much easier to raise than is startup capital. Let's talk about the process of projections here. There are 9 different steps that I use when it comes to developing financial models, and we're going to go through those one by one. They are the startup expenses, the sales projections, the staffing model, determining what your direct costs are, your operating expenses, your balance sheet activity, your cash flow analysis, and then capital engineering. Let's go through those one by one. The first step in the process is to determine your startup expenses. Now, this is an optional phase, because if you're already in revenue and we're developing a financial model that shows how you want to expand the business rather than start up the business, then it is optional. It's usually from 3 to 9 months in businesses that are just getting started. And we do this prior to any major revenue, or any revenue at all rather, and any major expenses that you might have. The reason why we do this is because it's very typical for the first 3 to 6 months before a company raises expansion capital, raises startup capital, that the model for the first 3 or 4 months or 6 months is much simpler than the model thereafter. And one of the big reasons we do this is because it tends to increase the revenue projections in the last year of the model, whether it be year 3 or year 5, which is very important to the valuation. One of the ways that we value a business is by taking the expected EBITDA or operating income in year 3 of the business or in year 5 of the business and multiplying that times a valuation multiple to get the projected asset value of the business, the acquisition value of the business in year 3 or year 5, depending on what the financial model is. And if you can take just those first 3 to 6 months and not include them in that projection, you will increase the revenue and the profitability projection in year 3 and year 5, and thereby increase the perceived value of the business in the mind of your investor. So that's why we do it, is because it makes pretty good sense to do that, to really start the business. I like to start the business as close to day 1 of revenue as possible. It really depends on the developmental cycle, but if it's only going to be first 3 or 4 months or 6 months even, we take that and put that off to the side and consider that kind of before the business gets going. Once we have determined that, we jump into one of the most interesting questions at all, which is sales projection. Is what are you going to sell, who are you going to sell it to, how much are you going to sell it, and how much is it going to cost you to make. So it's the sales by product and by distribution channel. And it also requires you to know what products that you're going to sell, the prices and costs of each product, and the number of the units that you expect to sell by channel, and the price variations by channel. So there are, by the way, price variations by channel. The biggest one being is whether or not you sell wholesale or retail. By the way, companies that have physical products will typically sell 85, 90, even 90% of all of their products wholesale. They sell some on their website. They sell some, at the back of a trade show booth or something like that. They sell some door to door, but most of the products that are sold wholesale. So you need to factor that into your financial models, certainly, because if you're only selling 5 or 10% of your products at retail, it's really the wholesale price of the product and the margin that you make when you sell on wholesale that will contribute to the bottom line and contribute to the viability of the business. You need to know that. And by the way, I have gotten into a couple of scenarios where they didn't know the answers to these basic questions. I had one lady a number of years ago that I remember was very excited about engaging my services to do the financial model, and asks if she could have 2 or 3 of the people who are on her team participate in the financial modeling process. And of course I agreed. I really don't like it to be more than 2 or 3 or 4 because it gets to be a lot of discussion. But in her case, I'm always happy for it to be 2 or 3 people. The very first question I asked was, okay, so what is it you're going to sell? They didn't know the answer to. Literally 2 hours later, the team was still discussing what products they might sell and at what price point they might sell them, and they simply were not ready to create a financial model that involved any sort of revenue projections or sales projections. So in that particular case, we stopped the process at that point in time. I gave them their money back because I hadn't really explained to them as deeply as I'm explaining to you today the process of financial modeling, and it just didn't work out. The other 150 times, by the way, I've done financial modeling, it did work out. But these are the questions that you need to know from the very beginning. And by the way, it can take 2 to 3 hours for us to go through the process of modeling the revenue projections based upon what you intend to sell, who you intend to sell it to, the price points that you're selling it, how you intend to sell it, etc. Once we have completed the sales projections aspect of the financial model, we move on to the staffing model itself, which is the salaries and the starting dates of all of your employees, all of your contractor fees and the engagement dates for your contractors. And typically we do this in detail for the first 12 to 18 months, and then it's looser projections thereafter. It's pretty easy to figure out who you're going to hire in the first 4, 6 to 8 months. It gets a little tougher around 12 months or 18 months. And frankly, almost nobody knows exactly who they're going to hire 12 to 18 to 24 months down the road. So one of the things I like to do with my financial models is that we plan to expand our staff after month 12 based upon the revenue projections that we have created. Because we do know that it's going to take some more people on board to say do $1 million a month worth of revenue than it does to have $100,000 a month in revenue, but we're not sure exactly what positions they're going to hold. We know that some of them are going to be in sales, and some of them are going to be in service, and some of them might be in accounting, and some of them might be in product development, and some of them might be in leadership, but we really don't know exactly what positions we need to fill 18 months, 24 months, 36 months down the road. So what's prudent to do is to raise the level of the staffing based upon the revenue per employee assumptions that we make for this. For some companies, you're going to have $250,000 a year revenue for employees. The most I've ever seen is for a very large company, was with Western Union. That was doing $4 billion worth of revenue per year with 4,000 employees. They had $1 million per year revenue per employee figure. Most companies, it's a lot less than that. For most companies, it's between $100,000 and $300,000 revenue per employee per year. But you can use that to automatically increase the size of the staff. Also factor in, by the way, bonuses and raises. I like to factor in bonuses where every quarter you're going to pay 10 to 15% of your available net profit in bonuses to those people who have worked so hard to help you make that profit. But that's not necessarily true with every company. After you've determined the staffing model, then we move into the direct costs. The direct costs are your product costs and your cost of goods sold. It's also your subcontractor and direct delivery cost. It can be your commissions, both internal and external commissions. So internal commissions at the vice president of sales level, of regional sales manager level, of individual salespersons level, and external sources ways in which you spend commissions, which is agents, brokers, affiliates, referral sources, etc., royalties that you might pay out, and credit card fees. All of these fees are directly related to the revenue, and that's why they're called direct costs. By the way, direct costs are also called cost of goods sold, and they're also called variable costs. I prefer the terminology direct cost with the mindset that these are the costs that vary directly with the amount of revenue that we have. The more revenue we have, the more direct costs we have, and if we don't have any revenue at all, by definition, we don't have any of these costs. So if you don't have any revenues, you don't have to pay commissions. If you don't have any revenues, you don't pay royalties or licensing fees. If you don't take revenues via credit cards, you don't have any credit card fees. And that's why they're called direct costs, and they usually vary directly with the amount of revenue that you have. Now, by the way, sometimes it's not exactly directly. For example, commission structures. Commission structures may actually accelerate with the more revenue that you have. And I'm a big fan of accelerators in your commission plans. So your commission plan may be that, up to quota, up to $1 million in revenue that you personally sell, you enjoy 10% of that in terms of a commission. But once you hit $1 million, it goes to 12% or 15% even at higher and higher. You get more commissions the more that you sell. So you have to pay attention to that with your commission calculations here and make sure that you factor in kind of the average commission, which may, by the way, increase over time as your revenues increase over time. We can talk a lot more about commission strategies later on in this session if you have any other questions about that. And I think I did an office hours presentations on compensation strategies as well. After we talk about direct costs, then comes the real fun, and that's the fun of talking about all the other operating expenses. And this is an extremely long list, and I'm just going to share with you some of the elements that we talk about whenever we do financial models around operating expenses. Here's the list. We talk about automobile expenses, bank fees, board of director fees, communication fees, which includes internet fees and emails and landlines and cell phones and fax machines. We talk about contributions that you might have to nonprofits and other charitable or social causes that you're engaged with. Dues and subscriptions to trade organizations, to chambers of commerce, to professional development organizations, education for yourself and your employees, employee relations, which is, coffee and snacks and, all the stuff that's in the break room, insurance, which are many categories of property and casualty insurance, errors and omissions, directors and officers, workman's compensation, health insurance, legal fees with patents and trademarks and licenses and intellectual properties, with your general counsel, with the securities attorneys, etc. Marketing expenses, which there are a bunch of those. Advertising, collateral, website development, trade shows and conferences, promotions and giveaways, etc. Office equipment like computer equipment and copying machines and refrigerators in your break room, etc. Office rent, office supplies, payroll taxes, printing expenses, and wait, there's more, product development, professional fees, software purchases, and monthly software leases. By the way, we're seeing a lot more expenses here with software as a service, where software as a service starts taking on a lot of monthly expenses, which vary based upon revenue or vary based upon staffing size. Sanitation expenses, taxes and licenses, travel and entertainment, uniforms and utilities can also be something that you do. And after you talk about operating expenses, there's this category of other expenses, which is interest, amortization, depreciation, and taxes usually, which all take out, some monies from the profit that you have. And it is a very, very long list. Some of those elements on the list vary by the size of the staff, and some of those elements vary based on revenues, and almost all of them increase over time. Fixed expenses are rarely fixed. We used to talk about variable expenses and fixed expenses. I don't like those terms. I talk about direct cost and operating expenses because your operating expenses are never fixed. They do increase over time as your revenue increases over time. Things like utilities and uniforms and certainly your insurance. As your revenues increase, as your staffing increase, these relatively fixed expenses will increase over time. They just don't vary directly with revenues like your direct costs do. Once we have completed the operating expenses, which as you can tell can take a considerable amount of time, then we focus on balance sheet activity, which is your accounts payable and how that might increase or decrease over time, your notes payable and how that might increase or decrease over time, paying special attention to any sort of installment payments or debt service that you've obligated yourself towards already. We talk about distribution of profits, accounts receivable, notes receivable, prepaid expenses, and inventory. All of these things consume cash or provide cash, but they're not on the profit and loss statement at all. They go on the balance sheet and they have an impact on the cash flow statement, but they don't really impact the P&L. Those fixed assets and other capitalized expenses are some more examples. So any time that you plan on buying buildings or buying land, computer equipment, office furniture and fixtures, plant equipment and machinery, the monies that you spend on product development and research and development, and the trucks and automobiles are all assets that you capitalize that don't impact your P&L statement, but rather impact your balance sheet and most certainly impact the cash that's required to start and grow the business. Once we've decided that, then and only then can we go into cash flow analysis. And in the cash flow analysis, I'm a huge fan of my month-by-month analysis of how you're going to gain cash into your business or your sources of funds and how you're going to use cash in your business, which is your use of fund. because it really does take cash to grow businesses. And many people are very surprised about the fact that, hey, I can be profitable from an income statement point of view, but it's still requiring more and more and more cash over time to grow my business. And why is that? And that's because it takes investments on a lot of different areas of your business to grow the business that don't show up on the P&L. Areas like inventory, accounts receivables, more fixed assets, marketing expenses in advance of the revenue that you might have to capitalize, other staff and staff-related expenses, and debt repayment and working capital. All of those things consume cash. And my experience is, until you do month-by-month sales projections, month-by-month P&L or income statement projections, month-by-month balance sheet activities, and month-by-month cash flow, that you really understand how much cash it's really going to take you to start and grow this business, and so that you have the opportunity to go back in and adjust your business model over time. Once you have determined the cash, then we can go into the capital engineering, which is the determination of how much capital that you need to raise and how to value that capital and what your company's worth. So first of all, you have to project all of the cash required, including some extra, and then we need to go into understanding the valuation of the business. I did an office hours presentation just a couple of months ago on valuations. I've been a student of valuations, especially valuations here in Silicon Valley, for a long time, because I find it so fascinating about how angel investors and venture capital firms value early stage businesses that they don't even know how much money they're going to make, and they certainly don't have any revenues at the time of the early stage valuation. And it is quite fascinating. Generally speaking, one of the things we do is like to do financial projections and then use the Harvard method, the internal rate of return method, the fair market value method, and many, many other methods of valuing the business so that you can determine how much of your business to sell in order to get the cash required. You do the financial models to determine how much cash is going to be required to grow the business at least through the next phase of development, and then you use one of these valuation methodologies and work with your professional investors, your sophisticated angel investors, your certified valuation analysts, your venture capital representatives to determine, how much is reasonable for you to receive in return for a portion of your business. The big key is that you want to make sure that you're providing to your investors a reasonable return. And I guarantee you that your sophisticated investors and the professional, the institutional investors with the hedge funds and the venture capital funds and other types of institutional investors will want to make sure that they're getting a reasonable return on their investment as well. So those are the 9 steps to doing a financial modeling process. And here's some extra tips for you. First of all, whenever you do financial modeling, it takes great spreadsheet expertise, in other words, Excel expertise, accounting expertise, and domain expertise to create reasonable models. By domain expertise, I mean industry experience. And by the way, whenever I help people create financial models, I bring the first 2 of those. I bring really great talents when it comes to creating spreadsheets. I oftentimes dazzle people with my spreadsheet skills, which I'm happy to do because I love to do it. And I bring significant accounting expertise to the model, but it's typically up to the CEOs and it's up to the leaders to bring their own significant domain expertise or industry expertise into it in order to create those models. After having done 150 models and having written 80 business plans, I know a lot about a lot of industries, but I'm certainly not an expert in every industry out there. It's up to you to bring that expertise to the table, and hopefully it's somebody that's on your team and somebody on your team full time. Here's another tip. A lot of CPAs and bookkeeping firms don't do financial projections. CPAs primarily do taxes and do audits. They don't necessarily look forward and do projections. And frankly, I've seen some really lousy projections come from accounting firms and bookkeeping firms because they're not used to the process of doing financial projections. They want to do them, but they're not necessarily very good at it. So before you turn to your CPA and rely on them to do your financial projections, please ask them whether or not it's something they do for a profession and do for a living. I don't do taxes for a living, and a lot of people who do taxes for a living don't do projections for a living. So make sure you understand the difference in between that. The common thread is we both have to have significant accounting expertise, which I have after having, helped in accounting departments for 40 years. And they have by virtue of their experience and their education, but they don't necessarily have good abilities to create financial projections in the same regards as you don't want to turn to me for tax advice because I don't have significant experience doing that. Like business plans, your financial models have to be updated every 90 days or so, and that's especially true if you're raising capital. When you are raising capital, you have a legal responsibility to communicate any sort of material aspect of your business. So if you plan on hiring somebody that wasn't in your financial model, if you figure out that your revenue stream isn't going to be there quite like you said that it was going to be, you have to adjust your financial model so that whenever you're communicating with your investors and investor prospects, that you are communicating the most up-to-date version of the business that you are asking them to invest in. What you don't want to do is go to somebody and share with them a 1-year-old, a 2-year-old, a 3-year-old financial model and present this as being current, because it by definition simply cannot be. And by the way, whenever you're raising capital, you also need to share with them the current financial history. So with the financial history, you need to update that every 90 days or so as well. Here's a couple of more tips. Number one, well, simply I said this, some financial modeling professionals, oh no, excuse me, I'll back up here. When I first got started in my career doing financial models, it never occurred to me to do anything other than deliver the financial model, the spreadsheet, to my client so they could continue to make tweaks to that over time. But not every financial modeling professional does that. Some of them actually will only deliver a PDF or a printout of the financial model. They don't actually deliver the Excel spreadsheet or whatever spreadsheet tool they were using to create the financial model in the first place. So make sure that you ask them whether or not they're actually going to deliver the financial model, the Excel spreadsheet, so you can tweak it over time, yourself or some other member of your team tweak it over time. And by the way, you want the same thing true of the business plan itself. So you want them to deliver the Word document, you want them to deliver the Excel spreadsheet so that you can make minor adjustments, minor corrections, word changes, number changes without having to engage their services at many hundreds of dollars an hour. And I said this before, I'll say it again, it really takes month-by-month balance sheet, income statement, and cash flow statements to understand the cash required to build a business. And here's a tip that's not on this list, is you have to make sure that your financial projections are consistent with your financial history. Any shrewd investor will take a look at your current financial history and the way you're spending and making money today and compare that to the way that you plan on spending money and making money tomorrow to see whether or not there's any inconsistencies there. I've seen too many people say, I'm currently paying myself $3,000 a month, but the second I get investor capital, I'm going to start paying myself $10,000 or $12,000 or $15,000 a month. Believe me, your investors don't want to see that because they're going to ask you the question of, well, if it was okay for you to be making $3,000 a month before, how come you need to be making $12,000 a month now? Why not take that extra $9,000 a month and invest it in growing the business so that they can get a better return on their investment? And you need to have a good answer for that question if that question ever arises. And the last tip, and maybe one of the most important things I'm going to talk about today, is no financial model ever comes true. I've done 150 of these. Not a single one of them ever came true exactly how we projected it. I consider it to be a major victory if you can get within 10 or 15 or 20% of your projections in the first year of the financial model. If you project $500,000 of revenue in the first year and you get somewhere between $400,000 and $600,000, believe me, that's a home run because it is all guesswork when we're just starting. If you plan to spend, $100,000 on operating expenses, and it comes out somewhere between 90 and 110,000, 120,000, believe me, that's a home run. And that's one of the reasons why you want to make sure that you create a business that has a significant possibility of income and a significant possibility of making a profit, because there are a lot of expenses that you cannot project. There are a lot of, you may get a windfall for revenues, but most of the cases Murphy's Law comes into play, and it costs more and it takes longer than you thought that it was ever going to. So if you're only projecting to make, a 30% gross margin or a 5 or a 10% operating income, I really encourage you to create a business model that at least has the possibility of having a 55 or a 60% gross margin, and has the possibility of having a 20 or a 25% or even more operating income, so that you gives yourself a really good chance of creating a business that's going to work in the long term. So here's the bottom line. There are a lot of great reasons for you to complete financial projections. And if you're going to share your financial projections with the professionals, with the sophisticated investors, with the accounting professionals, with the bank professionals, make sure that they're investor grade. And by investor grade, that means that it contains income statement, cash flow statement, and balance sheet month by month for at least 3 years. And for most of you, that means getting professional support. It's a rare business owner that I've ever met who has the capability of doing financial projections on their own. And by the way, that includes whenever you use one of these third-party packages for creating your business plan. If you use Palo Alto Software or Business Plan Pro, they almost make the assumption that you can create your financial models by yourself, that you know what kind of operating expenses you're going to have, that you know about the art and science of doing sales projections. And the bottom line is that it's usually not true. So when you do financial modeling by yourself without engaging the services of a professional, I think the odds of it coming anywhere close to being true are even more remote than they are when you engage the services of a professional like myself. That's been our agenda for today. We did a little overview about the process of financial modeling. We stepped through the 9 steps in the step-by-step process that I use to create financial models. We offered a few more tips and the bottom line. So here's what I want you to do for your exercises. Think about when and if you need to complete financial models or expense projections for your business. As always, get multiple quotes and check the references of anybody that you would hire to assist you in the process of financial modeling, and always work with a professional so that you can get that third-party perspective. So somebody can question your assumptions when it comes to operating expenses, and question your ideas about how much you're going to sell and when you're going to be able to sell it and how much it's going to cost you to sell it. And in between now and the time we have another conversation, I invite you to take a look at some of the related office hours presentations that I have done relative to the whole aspect of financial management. Number 11 was on cash flow secrets. Number 22 on reading financial statements. Number 46 on pitching to investors. Number 67 on valuing your business. Number 96 on strategic planning. And number 103 was on how to be great at financial management. All of those have something to do with the process of financial modeling and generally creating a viable business model for your particular business. In just a second, we're going to go into open Q&A and coaching, where you can ask questions and share comments on anything that came up for you, first with regards to financial modeling, and then any other subjects that you might have. I really want to know what your biggest takeaways are right now and the insights that you gained from these presentations. So if you could type that into your chat log, that would be great. I'd love for you to share that with me and tell me what you're going to focus on for the next few weeks when it comes to financial modeling. Our support services are 3 different kinds. We have education and training services, where we teach you great concepts and principles and invite you to do the work for yourself. As we do with financial modeling and writing business plans, there's a lot of things we do with you. Financial models, business plans, capital engineering, product funnel development, sales scripting development, and a lot of other things. We become a member of your team and work with you in a collaborative fashion to get those done. And every once in a while, there are things that we will do for you, such as the CFO and the bookkeeping work that we do, where you can literally throw that over the wall. We'll do it for you and come back and report the results to you. Our next office hours is going to be on June the 6th, which is 2 weeks from today. We're taking next Monday off because it's a holiday. Next Monday is Memorial Day, and we invite you to spend the weekend with your family, with your friends, do something special with those that you love, and join us again 2 weeks from today. We're not sure what the topic is going to be, but if you have any suggestions, go to paulsurvey.com and share with us what you would like for us to talk about in a future office hours session, and we'd be happy to consider that and do it. And in between now and the time we meet next, do your homework. And with that, we're going to invite open Q&A and questions. I tried to hurry through this, but there was a lot of material to do. So Stephanie, while I take a breath and take a sip, do you have any questions or comments from the folks who joined us live today?
Yes. Got a really good one here to start us off right off the bat, so drink fast. What is the difference between modeling for a nonprofit and a for-profit? We have quite a few of our clients who are doing nonprofits.
I'd say one of the biggest differences is that some nonprofits don't actually enjoy any revenues at all. They don't actually sell products or services. Most do, by the way. Most nonprofits will have something that they sell that generates income into the nonprofit, and they subsidize what they provide to their members of their community as opposed to, deliver everything for free. So some nonprofits don't have any revenue sources at all. The only way that they stay in business and keep their doors open is through repeated donations over time. So they will forecast, instead of revenues, they forecast donations. And instead of marketing their products and services a lot, they plan to spend a lot on the cost of getting those donations, or the cost of contributions, as they like to call it. So that's the biggest difference. The other big differences that I see are in the wages that they pay. So typically nonprofits will only pay 70 or 80% or even 60% of the wages that for-profit enterprises pay. Nonprofits also typically don't have the bonus programs, and there's certainly no concept of profit sharing. So a lot of their other expenses, the rental expenses, the insurance expenses, the postage, the marketing programs, those are all the same, but their wages and their compensations are typically much lower than I see at for-profits. And some nonprofits don't have any revenue sources at all outside the donations that they receive from people from the outside world. So those are the biggest differences. I'd say the other biggest one is that by definition, a nonprofit cannot have anybody who owns the business. You cannot raise capital for a nonprofit. There is no concept of distribution of profits. There is no concepts of ownership. By definition and by law, nonprofits are owned by the entire United States. A 501c3 is not owned by anybody, not the board of directors. It's owned by the entire United States. There are some exceptions to nonprofits like trade associations and homeowners associations, which are, quote, owned by the people that they serve, but it's not the same ownership as a for-profit enterprise. So those are the biggest difference, and there can be quite a difference in the financial modeling for a nonprofit because of what do you do with retained earnings. In some cases, you have a legal obligation to distribute all or most of the monies that you receive, to the constituents and to your membership base. In some cases, the monies received can go back into building up an endowment, but the monies received can never go into a distribution of profits or a distribution. They allow bonuses in some cases, but not a distribution of profits back to the people who work at the nonprofit. By the way, 95, 98% of all the work that I do is with for-profit enterprises. So only a few of my clients, only 2, 3, 4% of the clients I work with are nonprofits. So I certainly encourage you to get other people's advice and counsel when it comes to the financial modeling process for nonprofits. Stephanie, next question, please.
Okay. I have no idea what products and services I'll be selling. Do I need a financial model?
Well, as I mentioned earlier, You don't need a complete financial model because you can't do the first part of it. You can't do the sales projections, but you can still do a projection of expenses. You can project the staff-related expenses. You can project your operating expenses, but you just can't project revenues or direct costs because you don't know what you're going to sell or who you're going to sell it to, and you don't know what the costs associated with that revenue might be. So I still encourage everybody to create a budget. To create a budget as to what you're going to need to grow this business, to start this business over the next 3 to 6 months. It can be a pretty simple high-level budget. And by the way, I create these simple high-level budgets for my clients all the time. I typically have 2 different financial modeling processes that I use. One of them is what I call the first step financial plan, which may or may not have any revenue projections with it and is very high level, takes about an hour to an hour and a half to create, and is only the P&L with a little bit of hint on the cash flow. The investor grade financial projections are much more robust. They take 6 to 8 hours to create, and for those you have to have some sort of understanding about what you're going to sell. So even if you don't know what you're going to sell, you don't know how much you're going to sell it for, you don't know how much it's going to cost you, at least create a budget of planned expenses over the course of the next 90 to 100 to 160, 180 days so that you know how much money you're going to take to even begin pursuing the business, to begin developing the business concept that you have in mind. Hopefully that helps.
Awesome.
Stephanie, next question or comment.
Yes, we've got a, yep, here it is. How often do you recommend reviewing the financial models? One of our live attendees.
If you're yeah, good. I appreciate that. If you're raising capital especially, I recommend that you do it every 90 days because you have a legal obligation whenever you're raising capital to share with people your current financial history. And so that means every 90 days or so, and typically within 15 days or so of the close of a quarter, that you would update what you're sharing with your investor prospects from your financial history, and that take that same opportunity to update your financial model. So once every 90 days or so, in the interest of accuracy in disclosing and fairness and integrity in disclosing your financial history and your financial projections, that's when I recommend that you do that. So update your investor documents and update your financial projections every 90 days, which, by the way, may only take an hour, so it doesn't cost very much to do that. You don't have to start over typically. But my experience is with young companies, those raising capital, that change comes pretty quickly, that you can have some very significant changes in your business with new customers that come in that accelerate revenue projections, or revenue projections that never quite panned out the way you wanted them to because those early deals didn't come through. People come, people go. It costs more to develop products and services sometimes than you thought that it did. And so I think it's real important for you to make those changes periodically. Next, hopefully that was helpful. Next question.
All righty. How much time and money should I invest before I start selling and get into revenue?
Well, I think the answer is as little time and as little money as possible. I preach, and I think preach is the right word, that we want you to engage with your marketplace as soon as possible and then have a relentless pursuit of financial stability. So that as soon as possible depends on what type of business that you have. If you've got a business that has a very long product development cycle, for example, if you're bringing a consumer product to market, it may take you months and months and hundreds of thousands of dollars before you're able to get into revenue at all. If you have a services business, let's say a coaching business, you can take your coach's certification program, which, by the way, isn't really even necessary, and you can do that overnight and you can begin getting into revenue tomorrow. I've had some people say I wanted to go into coaching business because people kept telling me that I would make a great coach and wanted to hire me as a coach, and they were almost in revenue as a coach before they actually became a coach. So that's a really nice position to be in. It's pretty rare, but I have seen it happen. So I think the answer is it varies depending upon the type of business that you have, how quickly it takes you to develop your initial products and services, how quickly it takes you to develop your initial branding, marketing collateral, website, etc., so that you feel comfortable out selling your products and services, how long it might take you to close those first deals, and what your operating expenses and financial overhead expenses may be before you're able to enjoy that revenue. And I've seen that be anywhere. Like I said, I've seen people be cash flow positive before they open the doors of their business. And I've seen other companies not be in revenue for 3 or 4 years and expend millions and millions of dollars in product development and testing and certification before they're able to bring those products to market. By the way, the most complex business models that I've ever created, financial models, are around bringing medical devices to market. Because not only do you have a lot of development time and expense with those, but you also have the certification requirements, the FDA certification and the testing that you have to go through in the independent laboratories that require an awesome amount of expense before you're able to get into revenue with those. So it really does vary a lot. The answer is anywhere from $0 to $10 million, depending on the business that you are creating. And that's why it really makes sense for you to work with a financial professional to help you decide what is the right answer for your particular business. Next question, Steffi.
Okay. How much money does it really take to start a business?
I think I just kind of answered that one, as that must have come in before then. And the answer is it varies. I've seen people be cash flow positive before they opened up their doors, and I've seen other people do $10 million before they were ever able to generate a profit. Some rules of thumb are, people like to say that you should have 2 years worth of operating expenses, especially personal financial requirements, set aside before you start a business. That's a good rule of thumb. So if you are used to making $100,000 a year, it makes good sense not to go out and start your own business unless you have a couple of $100,000 set aside. I've seen a lot of people do it with less, but it really takes a lot of, a really relentless pursuit of financial stability to do it with less. If you're bringing a consumer product to market, I think it takes a minimum of $250,000, but really more like a minimum of $400,000 or $500,000 to bring any consumer product to market because of the cost of product development and the multiple steps in that process. In the prototyping process, it takes multiple prototypes. Then you get into low volume manufacturing, which costs you a lot per unit. And then you move into high volume manufacturing, which doesn't cost you as much per unit, but which costs you a lot to establish. I mean, $400,000 or $500,000 is the bare minimum that I would recommend that you have set aside before you bring a consumer product to market. And then, 1 or 2 years worth of your own personal financial needs as a bare minimum for any sort of service-related business. Hopefully that was helpful to you. I understand that it's not very much support, but without understanding exactly what sort of business that you have, the team that you have in place, the sales acumen that you have, the markets you want to enter into, where you are in developing your products and services, I can't really give you a better answer to that question. And by the way, I'll use that to talk about how we really believe that prescription before diagnosis is malpractice. So for me to just tell you it's going to take you $1 million or $2 million or $5 million without really understanding your business, the type of business that you want to create, the market you want to address, the need in the marketplace you're going to serve, the products and services you want to have, where you are in that development process, your own capabilities and the capabilities of other people on your team, I think it's malpractice for me to suggest to you what sort of capital you need to raise before we go through that really rigorous diagnostic process that we like to go through with every client that we have. And I have 102. So Stephanie, I know We've gone over just a little bit. Do we have one more question before we call it a day?
Yep, and I like this one. If your projections never come true, then why do them in the first place?
Good question, and I think I gave the answer earlier. It's business model diligence. You know, they never come exactly true, but every time I do financial modeling, there is something of significant value that we discover during that process. That somebody always discovers, wow, if I bring in product line B before product line A, I can make a lot more money quicker, and it's going to cost me less. Or they discover of, wow, I really can't pay myself $10,000 a month. I can only pay myself and other members of my team $5,000 a month for a while until the profitability picks up. Or, wow, I can't make money doing what it is that I wanted to do. I shouldn't even pursue this business model. All of those things are extremely valuable, and they provide a lot more value than the $3,000 or so that it takes to do a financial model in the first place. So I have never done a financial model that did not deliver significant value to my clients in terms of helping them make adjustments to the model that was going to make them a whole bunch more money or save them a whole bunch more money over time. And yes, sometimes 2 or 3% of the time we take a look at it and we say, this dog won't hunt. Don't go into this business because I can't see how you're going to make money at this business, or it's just not going to be profitable enough to you. You know, go back and think about this another few weeks before you come up with, before you invest your $50,000, your $60,000, your $100,000 in this business. I encourage you to think it through. And by the way, every time they've thanked me for that, because I've saved them 30, 40, 50 thousands of dollars a month of time in the pursuit of a business model that was not going to work. And I hope that certainly is never the case for you or anybody attending this call. We want you to make money. We want you to make a lot of money with your business. We want to do everything we can to support you in that. And so, so I encourage you to do that, to get somebody to help you with the financial modeling. If not me, then some other competent professional to help you do that. And with that, I think we're going to call it a day. We're not going to have an office hours presentation a week from today because it'll be Memorial Day. And I again encourage you to spend that with family and friends. And until we meet again, which will be on June the 6th, I believe it is, Monday, June the 6th, 2 weeks from today. This is Paul Hoyt and Stephanie May wishing you a most marvelous and prosperous day. Bye-bye.